This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 3 videos on trading climactic reversals. A climactic reversal is simply a failed breakout. Whenever you see a breakout and it does not look particularly strong, it usually means that the market is going to transition into a trading range fairly soon. Every breakout can succeed or fail. If it succeeds, it often leads to a measured move up and the breakout bar becomes a measuring gap. If it fails, the market usually reverses to beyond the start of the breakout bar, and the bar is an exhaustion gap. I think it's always important to be thinking about what the strong bulls and bears are doing at any time and what the weak bulls and bears are doing. One of the things that I always like to watch is whether or not bulls can make money in a bear trend. And if they can, that usually means the bear trend is weakening and the market will probably soon transition into a trading range. For example, if a bull buys this low and buys more lower, or simply, instead of buying this low, buys the size of a scalp or 2 lower and makes money, that tells me that this bear channel is probably not all that strong. It's a stairs pattern. The pullbacks are overlapping the breakout point, and it usually means that the channel will evolve into a trading range pretty soon. For example, we have a bear breakout, we have a second leg down, but some bulls will be buying below every low. And let's say a bull bought this low. He buys at the prior low. And he's willing to buy more, a point or 2 lower. Remember, when he's scaling in at a lower price, he always wants his next entry to be at least the size of a scalp. In the E-mini, that's 1 point. If he's adding to his trade, he wants to be buying 1 or 2 points below his first entry. So if he buys here, he might buy more here. And then, if the market gets back to his first entry, he can get out break even on his first buy, and then with a scalp profit on his second buy. And if that works, if the bulls can make money buying in a bear trend, it usually means the bear trend is not particularly strong, and it will soon transition into a trading range. Again, after the bulls see that they made money buying this low, they're more inclined to buy this low. They place a limit order to buy at the low and buy more 1 or 2 points lower. Other bulls, instead of buying at that low, they simply place a limit order to buy 1 or 2 points below this low. Will the pullback from this breakout go back above the breakout point? If it does, then the limit order bulls will make money. They buy with the limit order here, they might add on a point or 2 lower here. And then they place a limit order to get out break even at their first entry, which is at that low. And if the market allows them to get out, then they made money. They get out break even on their first entry and with a profit on their second entry. This is a stairs pattern where the pullback overlaps the breakout point, and it's usually the sign of a channel that will soon transition into a trading range. Trading ranges are always trying to reverse. It goes down, it goes up, it goes down, it goes up. A lot of sideways bars, a lot of bars with prominent tails. When you see the market behaving that way, the market's probably going to have trading range price action all day. And you can see here, intensely sideways, lots of reversals, small bodies, and the market is in a very tight range. Even though the market's having a bear breakout here, you have to suspect that this type of price action will last the remainder of the day. This particular trading range is about half the size of an average recent day, and therefore, if the bears get a breakout, the size of the breakout might be the size of this upper range. Strong breakout, we have a breakout, a 3-bar breakout, and consecutive bear bars. Not particularly big, but still a 3-bar breakout, and then an additional breakout here. The market's always in short, but look at the size of these breakout bars. Are they big relative to the bars to the left? No, not at all. They're really not big at all. And therefore, this is a weak breakout. Also, look at these bars. They have tails below. And look at the follow-through bar. It's a doji bar. And then we have another bear bar, a breakout bar with a big tail, followed by another doji. This is therefore a fairly weak breakout. 3-bar breakout, bad follow-through. Bear breakout, bad follow-through. Usually means that the breakout is not going to lead to a strong bear trend. When you have a breakout that's not particularly strong, you have to assume it's going to lead to a trading range soon, and if it's going to be a trading range, you may get a bull leg that retraces much or all of the breakout. In fact, a weak bear breakout might even lead to more than just a bull leg in a trading range. It could lead to a bull trend. In this particular case, it led to a trading range lasting 20 or 30 bars. Later in the day, it had a reversal from a slightly lower low major trend reversal. Bear trend, bull breakout by going mostly sideways, and then we tested down at the lows and we have a second entry buy going into the close. When you see trading range price action, you're going to be looking to buy low, sell high, and scalp. You can see the videos on trading and trading ranges for how to place those trades and how to manage your stops. When I'm talking about buying, it can be buying back shorts, or it also can be talking about buying for a scalp up. And when I talk about selling in a trading range, selling high, I'm talking about selling to take profits on longs and then also selling to scalp shorts. You're going to exit longs on any reasonable sell signal, and at the bottom of the range, you're going to exit shorts on any reasonable buy signal. Let's say a trader sees this as a potential bear trend that could last a long time. He might sell the close of this bar, betting that the market will continue down far enough at least to make a profit. A trader taking that short needs a stop above the most recent major lower high, which is the high of this bear breakout. And it would be better if he can scale in if it pulls back. Now what happens after the trader sees what followed? He sees 2 dojis, 3 dojis. He's probably disappointed, and a lot of the bears will buy back their shorts. And the bulls see that as well. They see doji bars after a weak breakout, and they think the market might be transitioning into a trading range. They like to take second entry buys. Here's a first entry buy above this bar, and above this bar is a second entry buy. This is a reasonable buy. And now we have a slight double bottom, and this is even better because we have a pair of bull bars, and buying above bull bars is slightly higher probability. Are the bulls buying for a swing up? No, this is not a major trend reversal. It's a minor reversal after a bear breakout. So the bulls are buying for a scalp. And they'll take a scalper's profit, 1 or 2 points above, or they'll look at a couple legs up and sell the close of a strong bull bar, betting against a bull reversal, instead betting that it's a minor reversal. And if you have a strong bull bar after a minor reversal has gone on for a few bars, it's probably not going to have follow through. It's probably going to reverse back down. Now, the bears who sold this close, they'll sell more. If they did not get out here, they'll say, okay, any reversal up is probably going to be minor. The sell-off is fairly weak, so we may get a pullback that's pretty high up, but as long as it stays below the top of this major lower high, it's still a bear trend, and therefore it's still okay to hold short. These bears are either selling a fixed number of points above, 1, 2, 3 points above, or at resistance like the breakout point, or they'll sell a strong bull close near the moving average. Here's a second strong bull close, a small wedge rally, 3 pushes up, 1 pullback, 2 pullback, 3, or they'll sell on a reversal down, like below that bear bar, adding to their short position from right here. And then if it gets back down to their original short, they'll buy back their shorts, break even on their first short, and then with a profit on their higher short. The bears who sold down here, willing to sit through a pullback, were hoping there would be no pullback. They wanted the market just to go down. However, they were confident that the reversal would be minor, and if it's minor, the market would probably come back to their entry price and they could get out without a loss, and if they scale in higher, they could get out with a profit on their second entry. If you sold this close hoping for a bear trend, and then you see this, and then you see a fairly significant minor reversal, you're probably thinking that instead of a bear trend, the market's forming a trading range. And they're disappointed by the size of this rally. And because it's a disappointing follow through after their breakout, and the breakout's not all that strong, the bears are probably switching to scalp mode. Sell the closed bears. they can either get out break even here, or they can add to their shorts for any reason, like below a bear bar at this bull close. Now we have a double top lower high, so they could sell below that bear bar, get filled over here, looking to get out around their low close. If you sold this close, your exit is here. You only add on if your second entry is at least the size of a scalp above your first. In the E-mini, that means you want the second entry to be at least 1 point above the first. If a bear sold this close, he gets out break even here. And part of the reason why the market reversed here is because you had disappointed bears buying at that low close. The bulls know that. The bulls see that they got a pretty good pullback, and they know the bears who sold the low closes are going to be buying back their shorts around those closes, and strong bears will place limit orders to buy at that low close, betting that they're buying at the bottom of what will become a trading range. They're betting against a strong bear trend. They see the trading range price action, they see the weak breakout, they see the pretty good reversal up. They think the market's in a trading range, so they'll buy for any reason near the bottom of the range. And one reason is buying at the low close. Stop entry bulls, some bulls prefer stop entries, they prefer second entry buys. Here's a first entry buy, not good after 4 bear bars. Here's a second entry buy. It's better, but it's still 3 dojis, no bull bar. And here's a third entry buy. You can call it a second entry buy, a small double bottom and a bigger double bottom. Bulls will buy a reversal up from the bottom of the range. This is a reasonable stop entry buy. All through here, the market is still always in short. And because it's still always in short, most traders are buying only for a scalp. I think it's reasonable to look at this as a double bottom major trend reversal, bear trend, bull breakout. The bears were unable to get the bear trend to resume for 15 or 20 bars, so that's a sign of decent buying pressure, and therefore buying this for a swing trade is okay. But look at the time. With this little time left in the day, most of the bulls who take this buy are only buying for a scalp. Most experienced traders do not like to reverse. So most traders are not buying this close and then reversing to short here and then reversing to long here. Usually, they like to wait a bar or 2 or 3 after they exit before they take a trade in the opposite direction. In part because trading is a little bit tiring and they need a break. And then the other reason is it's hard to be objective about taking an opposite trade when you're trading in one direction. Physically, it's also sometimes difficult to trade. You're more prone to make mistakes if you're trying to place a reverse order. However, if you can do it profitably and comfortably, then go ahead and do it. I want to talk a little bit about breakouts that succeed versus breakouts that fail, measuring gaps versus exhaustion gaps. Every trend bar is a breakout and a climax. When I use the term climax, I'm usually referring to a bigger trend bar. It's an acceleration of a move up or down. It's a relatively extreme change in behavior. These are all climax bars, relatively big bars. Here are buy climaxes. Here's a 2-bar climax. Here's a 3-bar buy climax. Here's a buy climax based more on time. 6 or 7 bars up, 5 of them bull bodies. And for the bears, a 2-bar sell climax, a big bar here, a couple follow-through bars, climax, 2-bar breakout, a 1-bar bear bar, 1-bar sell climax, a small sell climax, a small bear breakout attempt, a small reversal attempt. Most breakouts, most climaxes are minor, and they're just little parts of trading ranges or channels, and most are followed by minor trends or minor reversals or simply sideways trading. You can see the video on trading in trading ranges and in trading in broad channels for more information about how to trade this. Whenever you see a big breakout, for example, a bear breakout and a bear trend, after the trend has gone on for 20 or more bars, in other words, late in the trend, traders look for evidence of whether the breakout will succeed or fail. If it succeeds, they're looking at the breakout bar as a measuring gap. They're looking for a measured move down based upon the height of the range. If it's going to fail, they're expecting the gap to close. They're expecting the gap between this close and these lows to fail. They're expecting the market to reverse back up above these lows. And therefore, this bar, the gap attempt, is an exhaustion gap. Here we have a bear breakout, late in a bear trend. It's not particularly dramatic, but it is 3 consecutive bear bars, 2 closing on their lows, and we're breaking to a new low. You can argue there's a gap between the close of this bar and the low of the prior bar. That low, this low, that low, those are all gaps. If this is an exhaustive end of the bear trend, traders expect the market to rally above all of those breakout points. And that's what happened. The market reversed up, and this series of bear bars, I call it an exhaustion gap. You can call it a reversal. It is a reversal. But the bears were hoping for a measured move down. They were hoping that the market would not get back above, especially this bar, the bottom of the trading range, and instead would fall for a measured move down, become a measuring gap. But because it went back above that low and back above all these lows, this bear breakout is a failed bear breakout, and it's a climactic end of the bear trend, and I refer to it as an exhaustion gap. And this is a sign that the bears are giving up. A series of bull bars closing on their highs. When you have 3 decent bull bars like that, the market's probably always in long. Probably going to get at least a small second leg up. Now we're rallying, and now we're accelerating upward above the top of the range in a strong breakout. However, this is occurring about 20 bars into the bull trend. You have to be thinking that it might be a climactic end of the bull trend instead of the beginning of a stronger leg up. Right now there's a gap between the low of this bar and the high of this bar. The market might rally for a measured move up from the bottom down here to the gap here. It might rally for a measured move up, and therefore this would be a measuring gap. On the other hand, whenever you get a breakout, a buy climax, late in a bull trend, it's more likely to be an exhaustive end of the trend than the start of a new leg up. When you have a reasonably strong breakout like this, usually the market will have at least a small second leg up, and if it's going to fail and reverse down, usually there'll be at least a micro double top. At the moment that this bar closes, there are many different gaps. A gap between the close of the bar and any prior high, including the high of the bar right before the breakout began. And also there's a gap between the low of this bar. This bar sold off and rallied, so it's a pullback bar. There's a gap between its low and the breakout point right here. So there's a gap, this low, that high, and it could lead to a measured move up from the bottom of the bull trend to the breakout point and possibly up here. Strong enough breakout for at least a small second leg up. We have a second leg up, a channel. We got a measured move up based upon the height of this breakout, not a measured move up from the bottom of the range, from the bottom of the bull trend, but this is one reasonable measured move target. This particular breakout then became a measuring gap, even though it occurred 20 or more bars into the bull trend. In general, if you have a breakout occurring 20 or more bars into a bull trend, there's a 60% chance the breakout will fail. It might get one more push up and then fail, and a 40% chance of a measured move up. This is still fairly early in the trend. It's about 20 bars in, and it's a reasonably good breakout. I don't know if it's 60% chance that it's going to fail. It might be 50-50, that after a small second leg up, it'll pull back. Strong bull trend. And now we have a buy climax. We have a strong bull breakout, strong enough for a second leg up. Well, we got a second leg up. And look at these 2 bars. They're the best looking bull bars since the trend began down here. Big bull bars closing on their highs. Do you think this is an acceleration of the trend and the start of a new leg up? Or do you think more likely it's an exhaustive end of the trend? The trend is fairly weak through here, and then we're in a tight trading range here, late in the bull trend. Whenever you have a tight trading range late in a bull trend, you have to be thinking it might be the final bull flag. And if we get a breakout from that final bull flag, the market will reverse back down to that bull flag. Again, 60% chance when you have an especially strong breakout late in a bull trend, it's going to be an exhaustion gap. Once this bar forms and you get a pullback bar here, the gap is between its low and the breakout point here. There's a little bit of overlap maybe here, but it's still possibly a measuring gap from this low to right here. And then we have another breakout here and another pullback, but look at this bar. Its low fell below the breakout point above the high of this bear bar, so it already closed that gap. Also, this bar was strong enough to get at least one more leg up. It met the minimum requirement. Now we have consecutive breakouts late in the trend, a possible final flag. This is probably an exhaustive move, 60% chance. At a minimum, we're going to test down to the bottom of the buy climax. When you get a buy climax, you should not be thinking about a reversal into an opposite trend. You should be thinking about an exhaustive end of the current trend. The bulls are exhausted, they're going to take profits. They'll wait about 10 bars or so to see whether the bears can create a reversal. If the bears are unable to create a convincing reversal, then the bulls will buy again. If the bears get a pretty good leg down, when the bulls buy, they'll bet on a trading range. Big up, big down, big confusion, probably a trading range for the rest of the day. And therefore the bulls buying down here are now scalping instead of swing trading. If you see a climactic end of a trend and you're long for any reason, it's good to take profits. The market is giving you a gift. It's an exceptionally big surprise profit, and you should take it because whenever the market gives you something that is surprising, it usually is going to take it away. Beginners see this. Let's say a beginner watched the whole trend and hoping for a pullback. They got a pullback and they thought it was not very good, so they still didn't buy. And now they see this and they think, oh my gosh, this is becoming a huge bull trend. I got to buy. No, that's the exact opposite of what you should be doing. You should never be buying a breakout like this. It's much more likely to be an exhaustive end of the trend than an acceleration up into an even stronger trend. So the beginner who waited to buy all through here because he didn't want to buy the breakout, the stop was too far, and then he didn't want to buy here because the trend is weakening and it might reverse. Now he sees the trend getting strong again. Do not buy. This is more likely an exhaustive end of the trend, and the strong bulls will take profits, and the strong bears will sell, expecting the market to test down to the bottom of the breakout down here. Strong traders will sell the reversal down, or they'll sell closes, or they'll sell above this bear bar. Beginners can sell with a stop below this bear bar. We have basically an IOI, and we have a second leg up. 1, pullback, 2. We have a bear reversal attempt here, a bear reversal attempt here, and now we have a bear bar closing on its low. This is a reasonable short. Minimum goal is a test of the bottom of the buy climax and transition into a trading range. If a trader prefers higher probability, he can wait to see 3 or 4 consecutive bear bars and then start to sell closes. The only problem about selling this close is you're very close to the target. The market might bounce there. After 5 bear bars, if you sold here, the 5th bear bar, chances are the reversal up will be minor, but you still have to rely on your stop up here. And there might not be much profit left because strong bears will buy back shorts down here, and strong bulls will start looking to buy if they see the market stabilize around that low. Another opportunity to sell is here. We have a bull trend, a bear breakout, and a lower high. Tight bull channel, so not a strong sell, but now you have a second entry sell here, a lower high major trend reversal. You have a small bear body. At the end of the day, it's not going to be a major reversal. It's probably only going to be a scalp. However, it's a reasonable scalp. Some traders like higher probability trades, and they like to wait until the market is clearly strongly bearish. So selling the 3rd, 4th, or 5th close, it's a higher probability trade, but your stop is up here, whether or not you sold that close, or sold below this bear bar, or sold the 5th bear bar. The later you're selling, after you see evidence of a strong bear trend, or strong bears, you're paying for that higher probability with greater risk. You're selling further from where your stop is. And it's still reasonable to do it, although I personally don't want to be selling this low down in a bull trend day, especially when I think the target is the bottom of the buy climax, so there might not be much left to the trade. However, the probability of making money if you take that short is high. It's higher than the probability selling with a stop below this bear bar or selling that close. And that's always the case. All trading is a trade-off between good risk reward and probability. If you wait for a higher probability trade, your stop is going to be further away, so your risk reward profile is worse. If you sell this close and use a very tight stop, your probability is low, but the risk reward ratio is good. You're risking very little for a big reward relative to your risk. As I said, experienced traders, when they see a big bull bar breaking out late in a trend like this, especially with the potential final flag, they're going to sell. They'll sell that close, and they'll certainly sell the close of the second leg up, betting that it's much more likely an exhaustive end of the move, and the market is more likely to come down here than go up for the same distance. Here we have a strong bear bar, and it's probably the biggest looking bear body of this entire trend, plus it's closing on its low. When you look at this, do you think, wow, the bear trend is accelerating and we're going to get an even stronger bear trend? Or you're thinking, wow, this is about the 15th bar in this bear leg and about the 50th bar in this bear trend, and it's the best looking bear bar in the entire past 20 bars or so. Well, there's a 60% chance it's an exhaustive end of the trend and will trade back above its high, and a 40% chance we're going to get some kind of a measured move down. Is it a measuring gap, maybe from this high down to that gap, or is it an exhaustion gap? 60% chance it's an exhaustive end of the trend, only 40% chance you're going to get a swing down from here without pulling back first. It's really tempting for beginners when they see this to say, gosh, I didn't sell any of this, but now we have an even stronger bear bar. I got to sell. It's tempting to do that, but that's the exact opposite of what you should be doing. You should realize that the strong bears see this and say, wow, I was not expecting that. What a gift. I'm going to use it to take profits. We're late in a bear trend, and now the market's giving me a very big bear bar, allowing me to buy back my shorts at a very low price. And when the bulls see that, they're saying, that shouldn't have happened. That's got to be an exhaustive sell climax, and we're probably going to trade up. I'm looking to buy. A beginner can buy the reversal up here, higher probability to take the double bottom, higher low, major trend reversal. We have a bear trend, a bull breakout that lasted about 15 or 20 bars, and we have a second entry buy. This channel is very tight, and plus it's not that many bars down. It's probably a minor reversal, and this is a second entry buy, and now we're about 20 bars into the correction. This is a higher probability for a swing up into the close. Strong bulls, experts, will buy that close, betting that we're probably not going to fall very far, and we might be buying the low of the day. I want to talk a little bit about the behavior of strong and weak traders. Strong bull trend. Now what happens up here? Some bulls did not want to buy, bad follow through, tail, dojis. They're looking at this, it's not all that strong, they want to buy a pullback. And they finally have a pullback and they decide, well, it's not that strong, I gotta wait for strength before I buy again. And then they see this big bull bar and another big bull bar. Those weak bulls who did not buy down here suddenly decide to buy. They see extreme strength and they're hoping that the trend now is going to become much stronger than it was below. And that's a mistake. When you see extreme strength occurring late in a trend, it's more likely the final move. It's more likely an exhaustive end of the trend than the start of an even stronger leg up. The weak bulls buy, but the strong bulls have already bought, and they see this as a great opportunity to sell at a very good price. So the strong bulls are selling, not buying. And the weak bears who've been selling every reversal, hoping for a bear trend, finally give up. So part of this buying is the weak bears buying back their shorts. Part of it is the weak bulls buying, hoping for a strong trend up. But there are not enough weak traders. Most traders are strong. Most traders are institutional. And they're doing the opposite. The strong bulls see this and this. They're taking profits. They're going to wait 10 bars or more before they look to buy again. They expect that this is an exhaustive end of the trend. And the strong bears see the same thing and they're selling. Again, the weak bears who've been selling, can't take it anymore and they give up. They buy back their shorts. Those weak bears who are selling, and finally giving up, they know it might be a climactic end of the trend, but they're so exhausted and so afraid of losing any more. They've lost so much already today that they just have to get out. They're just afraid that even though the chance of it being a measuring gap is small, 40% or less, they don't want to take the chance. They've already lost too much today, so they have to buy back their shorts. Once the weak bears buy back their shorts, they're not going to be selling again. And once the weak bulls finally make the mistake of buying the breakout, who's left to buy? The strong bulls are not buying up here. And the strong bears, are they going to exit their shorts? No. The reason why they're strong is they're never going to exit their shorts. They're going to have stops way up and they'll keep scaling in higher. Who's left to buy? There's nobody left to buy. The strong bulls took the difficult trade. They bought the breakout early on. They bought the high 1 bull flag, the high 2 bull flag. They bought closes all the way up. Their stop is now very far below. When the market is up here, they're starting to take profits. When they see this, they're thinking, wow, that's a surprise. My stop is still down here, maybe down here. It's much further down than I want it to be. I'm going to reduce my risk, so I'm going to take partial or full profits. The reason the weak bulls did not buy here, they're afraid of risk. All they think about is risk. They don't want to blow their account. They worked hard to save enough money to try to become a trader, and all they think about is risk. They don't think about reward or probability, and therefore they're afraid to take the breakout trade. So they missed the trade, and the strong bears see this as a strong breakout on a higher time frame chart, even though it's bull bar, bad follow through, bull, bad follow through, bull, bad follow through. On a higher time frame chart, for example, this is a 5-minute chart. On a 15-minute chart, it's a very strong bull breakout. Those strong bears are not selling. They know the market's going higher. When the strong bulls see this, they know it's the weak bears giving up, and they know that the weak bulls are finally buying. The bulls who are afraid to buy all the way down here are finally buying. They know there's nobody left to buy, and therefore this is probably a climactic end of the trend, a good time to take profits. They take profits. As soon as this bar closes, they take profits. It creates that bear bar. Some bulls wait for a second leg up after this breakout. They take profits. That creates that bear bar, this bear bar. And then more and more bulls are taking profits. And bears are doing the same thing. They're selling. They're selling that close, creates that bear bar. They're selling that close, creates that bear bar. And then more and more traders are selling. The remaining bulls sell out, and the remaining bears sell in. A lot of the bulls are holding on to their longs, waiting for some sign that the final weak bears give up. And when they see this, they know the bears are giving up, and they're looking to take profits. The bulls are taking profits. They know the opportunity is probably going to be brief because they know that the strong bears are going to look at it as a great opportunity to sell at a high price. A lot of trading range trading here, a lot of trading range trading here, bad follow through after the bull bars. The market is soon probably going to convert into a trading range, and this buy climax is probably going to be the end of the rally, and therefore traders will be selling at the top of what might become a trading range. If you're a strong bull and you take your profits here or here, are you going to buy again 2 or 3 bars later? No, if you bought down here and you're finally taking profits, you're not going to be buying again 2 or 3 bars later. You're going to wait at least 10 bars. You also know that the market is likely to test down to the bottom of the most recent buy climax, and therefore you're not going to buy until the market gets down there, and only if you get a reasonable buy setup, and you probably want to wait for at least a couple legs sideways to down before you buy again. If a strong bull thought the pullback was just going to be a bar or two, he's not going to exit. If he thinks it's just going to be a little pullback, he's not going to exit. He's going to hold long. The strong bulls want to see if the bears are going to be able to create a strong reversal down. So they want to wait at least 10 bars or so to see how strong the bears are. And if the bears are not all that strong, then the bulls will buy again. But after 10 bars down in a tight channel and an exhaustive buy climax, they suspect the market is going to be in a trading range for the rest of the day, especially with all of these small bars here. Big up, big down, big confusion usually means a trading range. We have a tight trading range here, trading range price action. The strong bears know the bulls will see this as an opportunity to take profits, and that the bulls will not buy again for at least 5 or 10 bars, and at least after a test of this low. And therefore it's a great opportunity to sell for a scalp down to that low. They're doing the exact same thing that the bulls are doing. The bulls are selling to take profits. the bears are selling to get short. Initial target, the bottom of the most recent buy climax, right down here. And the bulls and bears both know a trading range is likely. This is a good location for the bears to take profits on these shorts. Tight channel, the bulls probably will not buy until we go sideways a little bit, and then they'll buy here, a small double bottom, this low, above that bull bar first entry, above this bull bar second entry, but they're only looking for a scalp up at this point. A lot of small sideways bars, a lot of doji bars. The market's probably going to be sideways for the rest of the day. Now, some strong bears started selling here. Maybe they started selling here. In any case, by definition, a strong bear is not going to be forced to buy back his shorts, only rarely. He's looking to short, he's going to look to sell higher. Not many bears are selling here, but they're definitely selling here. And these bears, they're going to need to see a really strong rally for them to get out of their shorts. They'll look at any rally as an opportunity to sell more at an even better price. Will the strong bulls keep buying, trying to force the strong bears out? No, they know the market's too expensive now. They see a lot of trading range price action. They see a rally with a lot of trading range price action. They know the market's probably entering a trading range. And the bears know that as well, and the bears are going to sell more higher. And therefore, the bulls are not going to be buying up here, trying to force those strong bears to give up, because they know they're going to fail. They know too many other bulls are going to be taking profits, and there will not be enough strong bulls buying up here to make the market go higher. Too many bulls eager to take profits, not enough bulls wanting to buy, too many bears wanting to sell. My general rule after a buy climax is the bulls will wait about 10 bars and 2 legs sideways to down before buying again. They want to see if the bears are strong enough to create a strong bear trend. If they are, the bulls do not want to buy. However, if the bears are not particularly strong, and they were not particularly strong here, then they'll look to buy for a scalp back up. Overbought market, buy climax, they know the breakout is going to attract strong bears, and therefore they expect the market is going to have a hard time going much higher. They're going to switch to looking to buy value. Instead of buying a breakout, betting on continued momentum, they're now only willing to buy value. They want to pull back. They want to buy cheap. Market pulling back, the bears unable to get a strong reversal. We're in the neighborhood of the bottom of the buy climax, in the neighborhood of this tight trading range where the market went sideways earlier. The bulls will begin to look to buy. Very tight channel, they'll wait for a second entry buy, like above this bar or above that bar. I began by talking about how a weak breakout usually means that instead of a trend, the market will soon transition into a trading range. I then talked about how breakouts can succeed and lead to measured moves, become measuring gaps, or fail and become exhaustion gaps. And finally, I talked about how weak and strong traders behave with breakouts. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 3 videos on trading climactic reversals. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 3 videos on trading climactic reversals. Some climactic reversals lead to changes in trend, and I call those major climactic reversals. And then I also want to talk about a climax based upon time more than price, a microchannel. A major climax is a big breakout late in a trend. Because these climaxes can result in an opposite trend, I'm calling them major climactic reversals. Remember, every trend bar is a breakout, every trend bar is a climax. Depending on context, I may simply call a trend bar a trend bar. I may call it a breakout, I may call it a reversal. If it's one or more big trend bars occurring 20 or more bars into a trend, there's a 60% chance it's going to lead to a climactic reversal, which usually means a trading range and sometimes an opposite trend. At a minimum, when you see a big breakout late in a trend, here a bear trend, here a bull trend, you have to be thinking about exiting your trades in the direction of the trend and considering trades in the opposite direction. If you sold for any reason, and then you see a breakout, here a pair of bars, the biggest pair of bear bars pretty much since early in the trend, especially after a trading range, which might be the final flag, you have to be thinking that it might be a climactic end of the trend. And if you see a reasonable reversal, here a pair of bull bars following the bear breakout bars, it's reasonable to exit at least part or all of your trade. If you want a high probability trade in the opposite direction, you wait until you get a strong breakout in the opposite direction. We're trying to reverse up here, not all that strong. It still might be a bear flag, but then we get a breakout and a follow-through bar. Some traders like to wait for a strong breakout with follow-through and then enter, because then the probability is higher. However, the later you enter, the further the stop is, and that means the risk is greater. That's always the case. Whenever you wait for a higher probability trade, your risk-reward profile is going to be worse. Climaxes often lead to reversals, especially if the context is good for a reversal. Here we have a bull trend, we have a good bull breakout, and we have 3 pushes up, 1, 2, or 2, and then 3. And then we have the biggest bull bar occurring about 20 bars into the bull trend. Also, it might be simply a buy vacuum test of the high. Whenever you see a particularly strong bull bar, 20 or more bars into the trend, it might be a measuring gap, 40% chance it'll lead to a strong trend up, but 60% chance it's going to be an exhaustion gap. Here we have a follow-through bar, good for the bulls, but then look at the next bar, a bear bar closing below its midpoint. A lot of the bulls will exit below that low, and a lot of the bears will go short, thinking that it's more likely an exhaustion gap. The gap at this point is the low of this bar and the high of the breakout point. 60% chance we're going to get a reversal down to that level. Probably a 60% chance we'll get a reversal down to the bottom of the buy climax. Since this looks like a trading range, we went down, we went up, we went down, we went up, we may get a fairly deep reversal. Parabolic wedge, 1, 2, 3, and we're getting a bull breakout above a bull channel, typically fails within about 5 bars. And when you get a dramatic breakout late in a trend, the first target is the bottom of the buy climax, and then if it keeps going down, the next target is a measured move down based upon the height of that buy climax. After a strong breakout like this, a lot of bulls will raise their stop. It's a major higher low, and if the bull trend is good, it should not fall below a major higher low. If it reverses down, it should form another higher low if the bull trend is still valid. If it's no longer a bull trend and has evolved into either a trading range or a bear trend, it probably is going to fall below that stop level. And therefore, if you're holding long at this point, let's say you bought for any reason, if you're holding long at this point and you did not exit here, a lot of bulls will get out below the bottom of this buy climax, because at that point they know it's no longer a strong bull trend, and they were holding long on the premise that it is. When the context is good, there's a 60% chance of 10 bars and 2 legs sideways to down. First target, the bottom of the buy climax. Here, a very tight channel. Is this leg 1 pullback, leg 2? Probably not. When the channel is very tight, it's usually the first leg down, and then we have a pullback and then a second leg down here. When I see a bar like this, especially with that tail on top, I'm either looking to sell that bar or getting ready to sell within a bar or two after that, or below the low of the follow-up bar. I would not sell below that bull bar typically because it closed on its high. But once you see a bear bar closing below its midpoint and having a reasonable sized body, a lot of traders are going to sell. They're going to sell at the market. Look at the open of this bar compared to the close of that bar. It's below that close, and that tells you that as soon as traders saw this bear bar closing below its midpoint, a lot of traders just sold at the market. Some of those are bulls who bought for any reason, and others are bears expecting a test down here and maybe a swing down. For the bears, it is a possible second leg trap. This is really a 2-legged first leg up. Is it a second leg trap? Is it 1 pullback, 2? Whenever I see a strong breakout in what might be a trading range, I always think that it might be a second leg trap. Here it's a 3rd leg up, but it's still basically the same principle. The market is going from trading range behavior and trying to break into a trend. most trading range breakouts fail, and therefore when you get a strong breakout near the top of a trading range, it's more likely a second leg trap, trapping traders into buying too high. If I'm long and I see we're up here, I might take profits on the close of either this bull bar or the close of that bull bar. More likely, I'm going to sell out of longs on the close of this bar or below the low of the bear bar. And bears will do the opposite. Some traders, instead of waiting for their stop to be hit, once they've seen 3 decent bear bars with 1 or 2 of them having decent sized bodies closing below their midpoints, they'll just sell at the market. Or here, you have a bull flag. We have a high 1 bull flag. But after 3 decent bear bars and a buy climax and only a doji buy signal bar, chances are there are sellers above for at least a small second leg down. A lot of bulls who did not exit on these closes or on the close of the bear bar or below the bear bar, once they see the 3 bear bars, they're going to exit on the close of the bear bar or above the high of the prior bar, and they'll get out here. The bulls are hoping this is a strong breakout and it's going to lead to a measured move up, either based upon the height of this leg and then a measured move up, or based upon the height of the entire rally and then breakout and measured move up. And the bears see this as a climactic end of a leg in what is probably a trading range, and they expect a test down to the bottom of the bull breakout, the most recent major higher low, and possibly a measured move down toward the bottom of the range. At this point, if you're a bull, your stop is here, here's your risk. If you're a bear, you're expecting the market to fall below the bottom of the buy climax, so that's the reward for the bears. Some traders will take the short, let's say sell that close, and risk for a measured move up based upon the height of the buy climax. And therefore, this would be the stop right above here for the bears. And the bulls see a breakout, they expect a measured move up, so that's their reward. The bulls and bears both have identical risk and identical reward, but what's different? Probability. An exceptionally strong bull breakout late in a bull trend, especially when it's not above the top of the trading range, is more likely an exhaustive end of the trend than the start of a new, stronger leg up. Therefore, if you say probably as a trader, that means you're at least 60% certain. And therefore, you believe there's a 60% chance that the market is going to come down here before it's going to go up there. The risk and reward are equal, but because the probability is at least 60%, it's reasonable to take the short. That makes the trader's equation positive. Again, the profit target is a test at or below the bottom of the bull breakout, the buy climax. Again, since the probability favors the bears, all they need is a reward equal to their risk to have a positive trader's equation. In fact, this is their initial risk. For the trader's equation, all you need is the actual risk. And therefore, if a bear sold, let's say at this close, their actual risk was just 1 tick above the high of this bear bar, which is very small. And if they exit down here, that is several times greater than their actual risk. And that definitely makes for a very positive trader's equation. Stop just above a measured move up. If you have pretty good context and a pretty good sell signal bar, you do not have to risk that far. You can simply put your stop above the top of the bear bar, the sell signal bar. The bulls might get 1 more leg up, and therefore this is a higher probability stop. And that's always the case. Whenever you use a wider stop, you're increasing your risk. You're also increasing the probability of making money. Both are reasonable, putting a stop here or putting a stop here. If you put your stop above the bear bar and you get stopped out, you would sell again on a reversal down. Once you get a pretty good reversal down, for example, 3 consecutive bear bars, if your stop was here originally, you would move it down to above the top of the new bear swing. Usually when you get these breakouts, it's 1 or 2 bars, not 3 or 4 bars. And traders know that, and especially with this tail on the top of this bar, a lot of traders will simply sell the close of this bar. The bulls sell to get out of longs, and the bears will sell to get short. What's more likely, a bull trend becoming a bear trend or a bull trend becoming a trading range? Well, probably a bull trend becoming a trading range, and therefore a lot of the bears will scalp out at least part of their profit until they're comfortable that the market has become always in short. Most climactic reversals result in trading ranges, and then once the market's in a trading range, then it often forms a reversal, a major trend reversal pattern, like a lower high major trend reversal that can result in an opposite trend. And because a trading range is more likely after a climactic reversal than an opposite trend, traders should think about scalping at least part of their trade, unless the reversal seems relentless. For example, here we have 3 bull bars, 4 bull bars, 5 bull bars. You have to be thinking that the bulls are taking control and the market is always in long. Once you believe it's always in long, then it's okay to swing your entire position, not just, for example, half of your position. And the same here. If you're thinking about scalping out around this low and you see 3 consecutive bear bars, the market's always in short and we're probably going lower, and therefore it's not as important to scalp out part of your position. If the market stabilizes and tries to reverse up, then you could scalp out. Again, it's always reasonable to take partial profits at the bottom of the most recent major high or low, the bottom of the buy climax. If the market does break below the bottom of the buy climax, you have to be thinking about a measured move down. The way I look at this is when the market gets down here, the bulls are hoping to form a double bottom. A lot of times it just keeps going down as it does here. But theoretically, the bulls are hoping to form a double bottom and then break above the neckline and rally for a measured move up. If the market breaks below this low, then it's breaking below at least a theoretical double bottom, and therefore you have to be thinking about a measured move down. And this is a good area to take profits, especially after a big sell climax. Also, you're low in the trading range. The market gapped up here, it rallied here, it rallied here. We're in that general price area. And remember, after the buy climax, you were looking for 2 legs down, 1 pullback 2. You're still in the trading range, and anytime you see a very strong breakout, a second leg in a trading range, you have to be thinking it's more likely a second leg trap than the start of a strong bear trend. Sometimes you hear people talk about a V bottom or a V top. Sometimes they'll call it an inverted or upside down V top, but those are rare. They sometimes happen on some very unexpected news event, but that's very rare. Almost always whenever you get a pattern that you think is a V top or a V bottom, it's something else, and there are clues that the market's going to reverse before the reversal takes place. With a true V top or V bottom, there are no clues. The market just suddenly reverses. And look what we have up here. We have a parabolic wedge top, and we have the test of the high of the day. This very strong breakout late in a trading range day is more likely a buy vacuum test of resistance than it is an acceleration up into an even stronger bull trend. Every buy climax is a test of resistance, even if it's not obvious, and every sell climax is a test of support, even if it's not obvious. This is a test of this low and of the bottom of a trading range day, and this is a test of the top of the trading range day. And it's also an attempt to break above the top of a very tight bull channel, and the top of the channel is resistance. This is a bear trend, and whenever you get an unusually big bear bar occurring 20 or more bars into the bear trend, it's more likely an exhaustive end of the trend than the start of an even stronger trend. Here, the trend began here, or here. Certainly this leg began here, about 20 bars back. And look at this bar, closing on its low, opening on its high. Very big bar, probably the strongest looking bear bar in the entire trend. Also, it's a second leg down. We have a trend here, a breakout there, and then a pause, and this is an attempt to resume down into an even stronger trend. This is a possible final flag. 60% chance this is an exhaustive end of the trend and the beginning of a trading range. 40% chance it's going to result in a measured move down. At the close of this bull bar, we have a gap between the high of the bull bar and the low of this pair of small doji bars. And therefore, the bears are hoping that this bear bar is the start of a strong trend down, and this becomes a measuring gap for a measured move down, either from maybe the top of this most recent leg down, maybe from all the way up here. 60% chance that's not going to happen. 60% chance the market's going to close, get above the breakout point below these lows, and get to the top of the sell climax. When the channel is very tight like this, the first reversal up almost always is minor. which means the market will test back down. And once you get the test back down, you start to develop a trading range, you can get a major trend reversal. This is a high or low major trend reversal, but this is a very tight bear channel. Usually that results in another minor rally, and the bulls will need some kind of a double bottom before they can get a reversal up. At this point, it's a double bottom, high or low major trend reversal with a good looking bull bar. This is a reasonable buy for a swing up. Very strong bear bar, no tails top or bottom, and it's the best looking bear bar late in a trend beginning here or here. Once you see a strong breakout like that, its high is major. The bears believe the market is still in a bear trend as long as the market does not rally above a major high. If it rallies above a major high, the bears then believe the market is no longer in a strong bear trend. It's either in a trading range or in a bull trend. If it's in a trading range, they'll sell. Here they have a double top bear flag, and they sold. But the bulls also had a potential high or low major trend reversal, and the bulls bought and the bulls won. Reasonable for the bears to put their stop above the high of this bar, because if they're selling, like a sell to close bear trend, they want the trend to keep going down. And if it does not, then their premise is wrong. It's no longer a strong bear trend. And this tells them that it's no longer a strong bear trend. Every reasonable stop is a magnet, and therefore, if the bulls get the reversal, they're going to try to get up here. Look at this bear bar, and look what followed it, a bull bar closing on its high. Most bulls will exit above the high of that bull bar and not rely on their stop. A lot of bears will either buy that close or buy above this bull bar, or they'll wait for 2 or 3 bull bars and then buy. Minimum target, the top of the most recent sell climax. At the close of this bar, what is more likely? That we're going to fall down here, a measured move, or go up to the top of the sell climax? Well, given the context, I would say 60% chance this is going to be a climactic reversal, an exhaustion gap that we're going to get back up above the top of that bar, especially after this pause, a potential small final flag. And therefore, a trader buying this close has a 60% chance of the market getting here before it falls that same distance. He'll put a stop just below. A bear selling that close has only a 40% chance of the market falling here before it gets up there. Risk and reward equal for the bulls and bears, but there are problems for the bears. In addition to a very strong sell climax, probably a climactic end of the trend, it's also around a measured move. The bears have a double top bear flag, neckline, fell for a measured move. And if you connect these lows, we're at the bottom of a channel. That is another type of support. So support at the measured move, support at the bottom of the channel. This might be a sell climax testing support and the end of the trend. Not necessarily the beginning of a bull trend, but the end of the bear trend and the conversion into a trading range. And then once in the trading range, the bears will try to get a bear flag, like a double top bear flag, and the bulls will try to get a reversal. Here, a double bottom, high or low, major trend reversal. At the close of this bar, you have bulls and bears trading. The bulls have a 60% chance of going up here before falling that same distance. The bears only have a 40% chance of falling that distance before hitting a stop above the high of this bar. Exhaustion gap, more likely than a measuring gap. So rather than some kind of a measured move down, more likely it's an exhaustive end of the trend and will get up to the top of that final sell climax. A lot of bulls will buy that close, betting that it's an exhaustive move, and they'll put a stop beyond the measured move down. Higher probability to buy a reversal up, especially above this bull bar and getting filled right here. Because the probability is high for the bulls, all they need is a reward equal to twice their risk. Their initial risk is here, and their reward is here. This is a reward equal to 1 times their initial risk. The trader's equation is based upon actual risk, and if a trader bought above the high of this bull bar and got filled here, their actual risk was only right here. The move up here is probably at least twice their actual risk, and that clearly is a positive trader's equation. Again, the bulls who buy here stop a little bit more than a measured move down and reward at the top of the sell climax. They can take partial profits here. If they thought the market was clearly always in long, they could hold for a swing. However, after a very tight bear channel like this, the first reversal up is minor, which means the best the bulls will get is a trading range. And once in a trading range, then they can get a major reversal. I want to talk a little bit about microchannels. A microchannel means that the high of the bar is below the high of the prior bar, below or at the high of the prior bar. Look at the chart. There's time here and there's price here. Every move is a combination of price and time. Some climaxes are based upon simply price. The market falls very far. But other climaxes can be based upon time. The market does something for a very unusual number of bars, and that becomes unsustainable. Do you think this could go down like this for 100 bars, 500 bars, 1,000 bars? No, of course you do not think that, and therefore it's unsustainable, and anything that's unsustainable is climactic, and that means that the bears will take profits and the bulls will start to buy for scalps. Whenever you have a bear trend that has persistent strength, 20 or 30 bars into the trend, you're probably exhausting the bears, and they're probably going to start taking profits. For example, at this point, the stop for the bears is way up here. And that is a lot of points for the bears to risk. And they're going to try to reduce their risk, and one way to do that is by beginning to take profits. And as the bears take more and more profits, the bear trend weakens and it starts to evolve into a trading range. When you get a breakout like this, you say, well, there's a doji bar here, pretty much a doji here. The bear breakout bars are not all that big, bad follow through here. That's all true. It does not look particularly strong on this time frame. But on a higher time frame chart, like a 15-minute chart, this would be a series of very strong bear bars. And because it's a very strong breakout on a higher time frame chart, on the 5-minute chart, traders should only be selling. Sell closes, sell anything, sell at the market. 18 bars without the high of a bar going above the high of the prior bar. At some point, no one's willing to sell, and the bears will begin to take profits, and they'll sell pullbacks, but they will not continue to sell in the bear microchannel. The market will have to go higher to find traders willing to sell. Whenever you have any kind of a climax, an unsustainable move, you have a 70% chance of 10 bars, 2 legs occurring fairly soon. In this particular case, we have about 10 bars, 2 legs, sideways to up. We went up, pullback, and then sideways. So we had at least 2 legs, 1 pullback, 2. We actually had 3 or 4, and sideways for about 10 bars. And that's the minimum objective after any kind of a sell climax, 10 bars and 2 legs sideways to up. What are the chances of a big bear breakout and an even stronger trend down? Only 30%, probably even less. I think it's important to remember that even though this sell-off lacks consecutive big bear trend bars and is not especially strong on this time frame, it is strong on a higher time frame chart, and bulls should not be buying. They're not going to make money buying. However, bears will be buying to take profits, and once you start to evolve into a trading range, then bulls will start to look to buy. We have the first pullback in a microchannel. High probability that the market is going to go down at least a little bit further, and therefore it's a reasonable short either below the low of this bar or below the low of this bear bar closing on its low. However, because this is climactic and the market's probably going to start to pause, go sideways to up a little bit, a lot of these bears will scalp. If a bear sold here and did not scalp out at the new low or anywhere down here, they'll probably buy on the reversal up. They don't have to. It's still probably only a minor reversal because the channel is still very strong. You only expect a major reversal after the bulls have had a pretty strong minor reversal. And this is a pretty strong minor reversal. And therefore, bulls will look for a major reversal. Here, a higher low major trend reversal. This is a final flag reversal. And a trading range is more likely than a bull trend. It's reasonable to take the buy, looking for a test of the sell climax, which is the most recent major lower high. But this entire trend is very tight, very small reversals, and therefore the market's still making minor reversals and a bull trend is unlikely. A trader buying here is probably going to be scalping out around here, betting that a trading range is more likely than a bull trend. But once you get the trading range and once you get a very strong minor reversal like this, bulls will begin to look for a swing up. For for example, a higher low major trend reversal. Sell climax, sell climax, sell climax here, 3 more bars, another sell climax. This is a series of sell climaxes. At some point, the bears get exhausted. They buy back their shorts, and then they wait for at least a couple legs up before selling again. If you want, you can call it a wedge. We have a low, a reversal, a low, a reversal, a low, and another reversal. I know it doesn't look like a wedge, but anytime you get 3 legs down that reverse, you have to be thinking that it's a type of a wedge. I think this is a reasonable buy, looking for a test of here, maybe up here. A micro double bottom, bulls could buy above this bull bar as well. Good context for a test up to these lower highs. If they buy above here or above here, a reasonable stop is below the low of this buy signal bar. Some bulls will buy here and they'll buy more below this bull bar, betting that the market is starting to transition into a trading range. For example, once they see that the bulls who bought this low and scaled in lower made money, they're going to assume buying at this low or lower will make money. And if it falls below this low a few points, it'll reverse up as well. So some bulls, rather than exiting just below the low of this bar, will buy more, betting that the market is in the process of transitioning into a trading range. And in a trading range, you want to buy low, not sell low. If you did exit down here and then you get another reversal up, the bulls would buy again. A reasonable place to take profits, you're testing the tops of the lower highs in the bear trend, and you've had 1, 2, 3, 4, a low 4 short. We tried to top out here, we got a breakout and then a wedge, 1, 2, 3. So it's a type of consecutive top pattern. Again, it's probably a trading range, and the market's probably not going to fall all that far. Another thing good for the bulls here is this channel is so tight, the odds are a reversal down is minor, and the bulls will get at least a small second leg up. And therefore, they'll look to buy this or above this bull bar for a major trend reversal. I said you can call this a low 4. I used to use that term a lot, and now I view it as consecutive tops. We tried to get a bear flag here, and instead of trading down, we got a breakout, and then we got 3 legs up, 1, 2, 3. Even though it is a low 4, low 1, low 2, low 3, low 4, I think of it more as consecutive tops. We have a complex top, low 1, low 2, and then a breakout, and then another complex top, low 1, the low 2 did not trigger, and then the low 3 did. Higher low major trend reversal. A tight bear channel, a micro channel lasting about 8 bars or so. A lot of bulls will wait for a second entry buy, like above this bull bar. A very small pullback bull trend, pullback just for a couple bars, 1 bar here. Very strong bull trend. But look at it. Are there any exceptionally strong breakouts? We have breakouts, but are they the biggest, strongest, most dramatic bars on the chart? They are not. And therefore, the market is not getting exhausted. There's no exhaustion, no exhaustive buy climax. Even though we're getting reversals on a higher time frame chart, like a 15-minute chart, there probably are no pullbacks. It's probably just a series of bull bars closing in their highs. If not the 15-minute chart, then certainly the 30 or 60-minute chart. It's a very strong series of big bull trend bars closing on their highs, and you should only be buying. You should not be selling here. You cannot make money selling. If you sell for any reason, you're going to lose. You have to assume that every reversal is going to fail. Even up here, even though it's a little bit climactic here, parabolically climactic, the first reversal down is probably minor and will result in a trading range. Even though I would not buy at that low, I would wait for a pullback closer to the moving average. If you did, the odds of losing money are small because the first reversal down almost certainly will be minor. The bulls will buy it and we'll get a test back up to that high. Many breakouts in the bull trend, but they're not particularly big, and therefore the bulls are not especially exhausted, and therefore the bulls will keep buying. Here's a weekly chart of the E-mini, and we have 11 consecutive weeks with bull bodies. Can we get 1,000 consecutive weeks with bull bodies? No, not realistically. At some point, you're going to get a bear body. This has never happened before in the history of the E-mini, 11 consecutive weeks with a bull body. And therefore, it's unsustainable. Can you get 12? Can you get 13? Can you get 14? Well, it's never done that, so it's unlikely that you're going to do it. And therefore, it's unsustainable. And anytime something is unsustainable, it's climactic. Even though the bars are not particularly big, it is a biclimax. On a higher time frame chart, like a monthly chart, it might be 3 or 4 big bull trend bars, and it might be a dramatic biclimax on the monthly chart. But on this chart, it's not made of extremely big bull bars, and therefore there's not much exhaustion. But it is unsustainable, and the odds are it's going to pull back into a trading range pretty soon, and therefore bears will sell. Like, for example, maybe they'll sell above the high of this high one bull flag after that bear bar. We have a bear body here, we have a bear body here, and we have an exhaustive biclimax, parabolic wedge, 1, pullback 2, pullback 3. We're probably going to get a couple legs down, and therefore bulls will start taking profits like above that bear bar, and bears will start selling like above that bear bar. Or here we have a micro double top with a big bear bar closing on its low. The bears might sell for a second leg down. Again, the odds of this becoming a bear trend are small. The first reversal down probably will be a bull flag. The best the bears can probably hope to get is a trading range. So the reversal down is probably either going to be a bull flag for a resumption of the bull trend or a trading range. Alright, so here's a monthly chart of the E-mini. We have 1 push-up pullback, 2nd biclimax pullback, 3rd biclimax. This is therefore a tight channel with 3 pushes up, and I call that a parabolic biclimax or a parabolic wedge top. It's also around a measured move up based upon the height of this trading range. This is probably going to evolve soon into a trading range, or pullback, or a trading range. Here, 38 months without touching the moving average. That has only happened in the cash index twice in the past 50 years. Do you think it's going to go 39, 40, 50, 60 months without touching the moving average? Probably not. Once you start to do something that the market has done only once every 25 years, it's probably not going to do it much longer, and therefore the odds are it has to get down to the moving average fairly soon. In 1987, the market was above the moving average, just like this, for 38 months, and then the market crashed. It fell 26% in one day. And then in 1997, the market stayed above the moving average for 44 months, but then fell 22%, a very big correction. And therefore, you have to be concerned that whenever the market is doing something extreme, the correction could be very deep. Tight bull channel all through here, you can only buy. You cannot sell. Pullbacks only lasting 1 bar, 1 bar, 1 bar, 1 bar. So you can only be buying. But at some point, once you start to get to a number of bars that has only rarely happened, a lot of traders will switch from buying at the market to buying pullbacks, like down to the moving average or reversals up. Here we have a double bottom at the moving average. I began by talking about major climactic reversals, extreme behavior that results in an opposite trend. And then I talked about how you can get a climax based upon bars that are small if you have a lot of them in a series, a microchannel, a biclimax or a sell climax based upon time more than price. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 3 videos on trading climactic reversals. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 3 videos on trading climactic reversals. I'm going to focus on minor climactic reversals in this video. A minor reversal is typically small and is not strong enough to lead to a major reversal of the trend. For example, from a bull trend to a bear trend, or a bear trend to a bull trend. More likely, it's going to lead to a trading range or a pullback. I think it's important to remember the market cycle. It's rare for a strong trend to reverse into an opposite strong trend. Usually it has to transition into an intermediate state first, like a trading range. And therefore, if you have a strong trend that is trying to reverse, the reversal is probably going to be minor and result in either a bull flag if you're talking about a bull trend, or a trading range. If you're talking about a bear trend and you get a fairly minor reversal, you're probably going to get a bear flag or a trading range. However, once the market enters a trading range, it then always tries to come up with a credible reversal pattern. About 40% of the time, you will get an actual trend reversal from a credible reversal pattern. The market's trending up, and now we get a bigger bar, and therefore it's a climax. There's a tail on top. There's a follow-through bar, which is good for the bulls, but that tail is a problem. If I were to draw a trend line connecting these highs, this is a bull breakout above these highs. It's also a breakout above a trading range, and it's also a parabolic wedge, 3 pushes up. 1, 2, 3. A lot of traders would consider selling the close of the follow-through bar, especially after this big tail. I think it's not likely to be a very profitable short because of how tight this entire channel is. Yes, it's a buy climax, but a trader taking that short probably has to use a fairly wide stop, at least a measured move up, maybe based upon the height of this final leg. So a stop up here, and he probably has to be willing to scale in higher to make money. However, a lot of bulls will take partial profits just in case we get an endless pullback and then a bear breakout. Typically, when you have a buy climax and a bear is selling, he's looking for a test of the bottom of the buy climax. And a test can be exactly down to the buy climax low. It could be a little bit below, or here a little bit above. And you can see at one time, this bar was a big bear bar with a close at the low, and then it got a tail into the close of the bar, and then the next bar reversed up. A lot of the bears who did not scalp out already will get out on this reversal up. They're afraid that this is going to be a double bottom. This low, testing that low, and then breaking above the neckline and rallying for a measured move. And the bulls know that as well. If you want, you can call it a high 2. There's a high 1 here, and then going above the prior bar would be a high 2 buy, plus it's a double bottom, plus you have a very tight bull channel. Therefore, it's likely that the sell-off is going to be a bull flag and the bull trend will resume. And therefore, bulls who are not long will buy above the high of this bar, betting on the high 2, knowing that the bears will give up. If you want, you can also call it a wedge. 3 or 4 pushes down, 1 or 1 and then 2 or 3, or 1, 2 and then sideways and then 3. Another breakout, you'd expect at least a small second leg up, and the bulls got it. But a fairly tight trading range late in a bull trend often becomes the final flag. And look at this. We have a bull bar, bad follow through. Bull bar, bad follow through. A pair of bull bars, shrinking bodies, and then a doji bar. This is a wedge higher high. And a lot of the bulls will get out below this low, betting that we'll get a couple legs down. This is the end of the day. There's no time for 2 legs down. However, the bulls who did buy would either get out below this doji bar, on the close of that doji bar, or maybe on the close of this bear bar. When you're selling a buy climax, the goal is a scalp. However, if you get decent selling pressure in the reversal down is minor, then the bull trend resumes and reverses a second time. That is more likely to lead to a major reversal. This is not much selling pressure. The market went sideways for about 7 or 8 bars, but where are the consecutive big bear bars? Why did it not fall below the buy climax low? Why are there no very big bear bars? This is probably not a strong enough minor reversal for traders to look for a major reversal. And also, the end of the day, do you want to be selling this for a swing down? There are only 3 bars left in the day. You're not going to get a swing. You can call it a small major trend reversal, higher high, major trend reversal, wedge higher high. But end of the day, if you're selling, at best you're hoping for a scalp because it's not going to fall all that far when there are only 3 bars left in the day. When you have a fairly strong bear trend, even if it's climactic, the first reversal up is typically minor, which means it becomes a bear flag or a trading range. However, once it enters a trading range, then it has a chance, or better chance, of a major reversal. We have a bigger bear bar after 2 or 3 smaller bear bars. Actually, this bar is the biggest bear bar in this entire series of 6 bear bars, and therefore it's an increase in the selling and therefore climactic. It's also forming about 20 bars into the trend, and when I look back at this, it's probably the single best bear bar in the entire trend. When you get exceptional strength late in a trend after 20 or more bars, it's more likely to lead to exhaustion than an acceleration of the trend. Exhaustion, an exhaustive sell climax, does not mean the market reverses up. It means that the bears are exhausted, they'll take partial profits, bulls might start to scalp. However, the reversal up usually tests the top of the final sell climax, this high, and then enters a small trading range. When you have a very tight bear channel like this, the first reversal up is not likely to lead to a bull trend. You're probably going to need some kind of a double bottom, and the bear trend will probably resume. You can see it tested the low close here. However, once you get that double bottom, you have a better chance of a major reversal. So sell climax in a very tight bear channel, minor reversal into a trading range. And once in the trading range, the bulls will try to get a double bottom. Here, a slightly higher low. It could be a lower low. It could be an exact double bottom. And once you get that, especially with a good-looking bull signal bar like this, there's a better chance of a bigger reversal. This entire series of bear bars, 7 bear bars, is a climax, and the market may test up to the top of that climax, which it did. When you have the sell climax bar and then you have a follow-through bar, especially with the tail and not a particularly big body, some bulls will buy looking for a test up here. Again, first reversal up is minor, and therefore bulls buying here, in general, are mostly looking for a scalp. Bulls buying here, some will scalp part and some will swing. And once we've had 3 decent bull bars like this, the market's always in long, and we're probably going to the next major lower high, which would be the top of this series of bear bars. And the bulls who did not fully scalp out would take more profits here. After this many bars up, we're likely to go higher, so the bulls might be holding on to part of their position even after this. Is this a big enough pattern for a major reversal? Not typically. Sometimes if it's in the first hour, a small pattern can be a major reversal. Here we have a sell climax on the open. Even though it's at 8:30, it could be the low of the day, and therefore it's reasonable to swing at least part. And once you start to get a series of bull bars, like here, 3 bull bars, 4 bull bars, it's by the close, it's always in long, and it's likely that we're going higher, and this might in fact be the low of the day, and therefore this could be a major reversal. For the bears, very tight bear channel. First reversal up, not very strong. The entry bar has a big tail on top. The signal bar has a bear body. The next bar, tail, small body, and then a bear bar, another bar with a big tail. At this point, this is a bear flag, and a lot of bears will sell, at least for a scalp. Because of the prominent tails and small bodies, this is likely a bull leg in what will become a trading range, and therefore the bears selling here, for the most part, will scalp. Not a good-looking sell signal bar. It has a bull body. So again, trading range behavior, bears selling for a scalp. They might swing part because we're still in a bear trend, but you got 4 bull bars, no strong bear bars, not a good sell signal bar. Probably the first leg down will be bought and will either enter a trading range or form a double bottom and reverse up. We have a pretty strong bull trend here. You can argue it's a second leg trap or a parabolic wedge, 3 pushes 1, 2, 3, or 1, 2, 3. We have a breakout. You'd expect a second leg up. However, it could simply be a buy vacuum test of yesterday's high and the high of today, especially after a big sell-off like this. When you get a big sell-off here over 10 points and a reversal, usually the reversal does not lead to a big bull trend. It can get to a new high. However, it usually does not go strongly up from there. Usually it enters a trading range. At this point, we have a fairly strong bull trend. Every bar has a low at or above the low of the prior bar. The first reversal down, probably only minor, which means a trading range or a bull flag. Not likely to enter a bear trend without first going sideways and creating a major trend reversal. We have a gap here. The market is rallying weakly, and then we have a big breakout. Is this an exhaustive end of the trend? It might be. It might be a buy vacuum test of the top of the bear leg, and it's a second leg up, 1, pullback, 2. Could be a second leg trap. However, I think more likely this reversal up is so strong that this sell-off is probably the low of the day, and today's going to be a reversal day, which means we'll probably get up near the high of the day, maybe a little bit above. Probably a measuring gap from this low to this high, the market probably will rally for a bottom measured move up. The bull's getting a very big bull breakout above a bull channel, fairly tight bull channel. Again, it could be a parabolic wedge. It is a parabolic wedge. Some traders would say this is the first push. Others would say this or this was the first push, and then second and third. Big breakout above the top of the bull channel. Also, a breakout above the high of the day. But look at the size of this tail. So that is a lot of selling. And when you get that much selling up there, probably you have big up, big down, big confusion, and probably sideways for a number of bars. This is probably an exhaustive buy climax. This is probably a buy climax that will lead to a measured move up. This is the biggest bull bar, 20 bars or so into the bull trend, failing at yesterday's high, trying to break above the top of a bull channel and failing. Probably the market is going to go sideways to down for about 10 bars. The bulls will get out. We have a bear II, a pair of bear bars. We have a bear bar closing on its low. Bears will sell here, at least for 2 legs down. 1 pullback 2, or 1 pullback into a triangle, and then 2 or 2. And bulls will get out. Whenever you have a bull trend and then a tight trading range, it's always good to be looking for some kind of a double top. If you get a double top, especially one with a decent sell signal bar, you'll have a 40% chance of 2 legs down, 1 pullback 2, and therefore bears will look to sell. Usually you do not get the reversal until the trading range grows to at least 10 bars. Here's a double top, but barely 10 bars. You have a bear bar, you could sell below that. You can see we broke above this high, and now we got another reversal bar. Again, a bull bar, not all that great. We have another reversal bar here. At least it's not a bull bar. It's failing at this high again. Probably a 40% chance you're going to get at least a couple legs down, so a reasonable sell. 60% chance is going to continue sideways, or it'll just go up. However, 40% chance of a swing down where the reward will be at least twice as big as your risk, and therefore the math is good for the bears. Their actual risk, if they sold below the low of this bar, is to just above the high of the bar. And if they exited above this bull bar or above this bull bar, they made many times greater profit than the size of their actual risk. That is a very good trader's equation, and therefore it was reasonable to take that short. Entering in a tight trading range, your stop is not far, either above the high of this sell signal bar or above the high of this sell signal bar. Your risk is not great, and that immediately tells you that the probability is not all that great. Whenever you have a very good risk-reward profile, small risk or great reward, the probability of achieving your goal before your stop is hit is small, right? So also entering in a tight trading range with a stop is always going to be a low probability bet because the market is very balanced and you're betting that, in this case, the bears will win. At best, you have a 50-50 chance. Following a strong bull trend, you probably only have a 40% chance. But the math is good. Some traders do not want to take the low probability trade, even though the risk is small. They wait for a breakout with 1 or 2 very big bear bars or 3 ordinary bear bars and then sell. At that point, they have a higher probability trade, but their stop is further away. In other words, the risk-reward profile is worse, but their probability is better. For example, the bears could sell the close of this bar and put a stop maybe above the top of the 3 bear bars, expecting at least 2 legs down. 1, pullback 2. And once you get a confirmed breakout like this, 3 consecutive bear bars breaking below the trading range, the close of this bar below maybe 10 or 15 bars, and the close of this bar, a second follow-through bear close after the bear breakout, the probability is high that you'll get a second leg down. And typically, when you have a double top, tight trading range, lower high, major trend reversal like this, the second leg down is bigger. It's climactic. Double top here and here. If you want, you can call it double top here and here. And it's a lower high. We have a bull trend, a bear breakout below the bull trend line, and therefore it's a double top and a lower high major trend reversal. It's a type of lower high major trend reversal in which the lower high has a double top. You can also call it a triangle. We have 4 pushes up, 1 pullback 2, pullback 3, pullback 4. Because the second leg down is typically climactic, a lot of the bears will take profits above the bull bar, especially since it's also a breakout test of this high and it's a higher low. and we have big down, big up, big confusion, usually results in a trading range. Trading ranges have deep pullbacks from strong legs. This is a strong leg, this is a deep pullback. More likely, we're going to form a higher low than a new low. If you get a bull bar like this, closing in its upper half, I think you have to get out above it, or certainly above this bull bar closing on its high. Here's the open of the day, and we have a big bear breakout, consecutive bear bars. The market's always in short. However, whenever the market makes a strong move on the open, there's a 50% chance the move is in the wrong direction. We have a bear trend, and then we have a trading range late in the bear trend. This is probably going to be the final bear flag. We might get a second leg down after two big bear bars like this, but we're getting a reversal up. And this is actually kind of interesting. This is the first reversal up when the market went above the high of this bull bar, and then the market tried to resume down with this bear bar, and then it went above the high of that bear bar as well. This is a type of second entry buy above the high of that bear bar for a failed breakout below yesterday's low. A second entry buy. The first is above this bull bar, the bear trend resumed, and the second is above that bear bar. Whenever you have a bear trend, you have a 50% chance of some follow-through selling on the open of the next day. Sometimes it's on the open, sometimes it's an hour later. But you also have a 75% chance of at least two legs sideways to up beginning by the end of the second hour. And therefore, if you get a sell-off like this, you have to be aware there's a 75% chance you're going to get two legs sideways to up. Here we got two legs sideways. First leg, pullback, and then second leg. This is too small. First leg, pullback, second leg. The pattern is too small to correct this. Typically, the pattern is going to last about 20 bars. So I'm looking for a correction that's going to last at least 20 bars. On a 5-minute chart, that's about 2 hours. Here, it lasted all day, so it lasted more than 5 hours. This is a pretty good buy above this bull bar, betting on a final flag and an opening reversal, a sell vacuum down to below yesterday's low, and a failed breakout below yesterday's low, a big magnet here, trading range, a lot of trading range price action yesterday, and therefore probably a lot of trading range price action today. And if you see a strong breakout below the trading range, you have to bet there's at least a 50% chance the breakout's going to fail. And when it's happening on the open like this, 50% chance that you're seeing the low of the day occurring right on the open. Is the market always in long on the close of this bar or this bar? Probably not. But by the time this bar closes back up near the high of the day, 3 consecutive bull bars, 2 with very big bull bodies, a second entry for a failed breakout below yesterday's low. By the close of this bar, the market's always in long, and traders believe we've seen the low of the day. It turns out the market did not get back above the close of that bar, or it did not close above the close of that bar, but we knew the odds were, at this point, we were not going down here. We have a higher low major trend reversal, 40% chance of a swing up, 60% chance of a small profit or a small loss, and that's what the traders got. Trading range late in a bear trend, probably going to be the final bear flag if the bears get a bear breakout. The bulls are trying to get a double bottom here, break above the neckline, measured move up, and the market opened below that close. The bulls who bought that close are now trapped. The market sold off sharply, and then strong bulls bought on the reversal up, betting on the low of the day. We have a big gap up, and we sold off on the open, and we sold off in a small pullback bear trend through here. And now the market's accelerating down. We have 4 consecutive bear bars closing near their lows, breaking below this low 2 short, low 1, pullback low 2, a tight range. Do you think this is the start of an even stronger bear trend? Here we are, maybe 60 bars into the day, and we're starting to accelerate down. Or do you think it's more likely a sell vacuum test of support? One area of support, yesterday's close, yesterday's low, and this is probably more likely a sell vacuum test of support. It's a strong enough sell-off so that it's probably going to have at least a small second leg down, and this is a small second leg down. The bulls broke above the tight bear microchannel, and the bears tried to resume down, but all they got was 1 bar, and then the market reversed up. Ultimately, the bears got a double top and a break below the neckline of that double top, and a sell-off down to yesterday's close at the end of the day. However, at this point, you have to be thinking that it's not likely to be a measuring gap. It's more likely to be a bear trap, trapping traders into believing the bear trend is going to accelerate down. After the market sells off for 60 bars like this late in the day, especially when the sell-off has a lot of sideways trading, traders typically look to lighten up. They look to take partial profits. And therefore, if you get a sudden big breakout, a lot of the bears are going to say, wow, there should be some short covering at the end of the day. Bears will take profits. And here we're getting an opportunity to buy back our shorts at a very low price. It's probably not going to last long. And the bears bought back shorts. Ultimately, other bears decided that we have a gap bar, first bars with lows above the moving average, gap between the moving average and the lows of the bars, betting that we would get at least a test back down. So other bears sold again here. If you want, you can call this a wedge bottom. 1 pullback, 2 pullback, 3. A test of yesterday's close, even though not quite there. We're trying to get a bear breakout below the bear channel. Usually you'd expect it to fail. A lot of bulls would buy the first reversal up or the second reversal up. Some would buy the close of the bull body right there, or the close of that bull body, betting that it's the start of a reversal up. When the channel is this tight, is the market going to reverse into a bull trend? No, it's probably going to reverse into a trading range. However, it's reasonable to buy looking for a test of the most recent major lower high, which is the top of this sell climax. And you can see traders took profits there and bears sold again up there. When you're buying in a tight channel, you're buying for a scalp because the reversal up is going to be minor. Probably 70% chance, 80% chance it's going to be minor. And that means you'll get a test back down. You might then get a major reversal, or you might get a resumption of the bear trend. The bulls who bought here, disappointing entry bar here, bad follow through here, good breakout here, but small bar here, gap bars late in a trend. Usually the market will try to resume down one more time. The initial goal for the bulls was a scalp up to the top of the sell climax. And you can see once it got there, the bars started getting small. We started getting dojis. The bulls are selling out of their longs to take profits. They lack conviction. The bears see the lack of strength up here, and they start to sell again, betting that these gap bars, while a sign of strong bulls, will not be enough to reverse the trend without first testing the low of the bear trend. Higher low major trend reversal, but not really. Not enough bars down, maybe enough bars up. Also, when you get 3 decent bear bars like this, the odds are there'll be sellers above and you'll get at least a second leg down, and therefore this is not a very good buy. Now this, is it a very good sell? You can argue it's, I don't know, is that 8 bars without a pullback? So it's an 8-bar bull microchannel. First reversal down, minor. Usually you get a second leg sideways to up. And the bulls got their second leg sideways to up, a lower high, and then the bears got a second leg down from this climax. For the bears, a double top with this high and that bar, a double top with this high and that high. Reasonable sell. We have a bear bar here. The market's evolving from bull bars to weaker bull bars to doji bars and now bear bars. A reasonable swing short, looking for one leg down. Gap bars usually lead to the final leg of the bear trend before the market attempts to form a major trend reversal. This could turn out to be a scalp. It's a reasonable swing. We're running out of time in the day. We only have about 10 bars left, but sometimes you'll get pretty good selling and the result could be a swing. Here, it does not look like much, but it's actually 10 points or so in the final hour. So that is a swing short. We have a reversal up and we're stalling at the top of this trading range. And you can also call it a wedge, 1, 2, 3, or a double top and a bull breakout that might fail. This is probably a final flag top. We have a reversal up and then a trading range and then a breakout, big tails, testing a prior high, probably going to be a trading range. 60% chance of the end of the rally for at least 10 or more bars and possibly a reversal down. Only 40% chance this is going to lead to a measured move up. This close is at or above the top of this tight trading range and at or above the top of the past 30 bars or so. And then we have a bull bar follow through. However, the big tails on top of both make it likely that we're going to go sideways to down for at least 10 bars. It's still a possible bull breakout and follow through and measuring gap. 40% chance we get the measured move up, 60% chance we go sideways or down. Some bears will sell the close of that follow through bar. Both bars with big tails, possible final flag. test of the top of the range, a reasonable sell. However, if they did take the sell and the market tried to reverse up here, and now it's trying to reverse up a second time, the bears will exit taking their loss because they're afraid that instead of an exhaustion gap, this could be a measuring gap. Here's an attempt by the bears to reverse, and look at the low of this bar and the high of all of these bars. This is only a test of the breakout point, not a reversal, and it's not closing the gap. In fact, it's creating a gap between this low and that high. That increases the chances that this gap between that low and this high will be a measuring gap, and then we'll get a measured move up. Minimum would be a measured move based upon the height of this trading range, but possibly a measured move based upon the height of this entire rally, which could be a bear leg in a trading range day or a large bear flag. Bear trend with a deep pullback, we might continue all the way down. The bulls know the bears failed. The bulls know the tails up here are bad, but they know a lot of bears will get out above this bar, a high 1, and now we have a bull inside bar after this bar. It's a type of high 2. What this is possibly a bull flag, and then this bull doji bar is the breakout. This inside bar is the pullback. So it's a small bull trend, bull flag, breakout, and pullback. The bears will give up, and the bulls will buy, betting that this low is testing that high, and that we have an open gap, and that we're going up for a measured move. And that's what ended up happening. We got a measured move up based upon the entire rally. Even though the breakout has a big tail, the follow-through has a big tail, and the follow-through after that is not all that good, you got to look at the reversal attempt by the bears. A tail on the bottom and did not get below the breakout point. And the bears tried again a second time. Tail on the bottom did not get below the breakout point. The bears are going to buy back their shorts, and the bulls are now confident that this sell-off attempt is simply a test of the breakout. It's a breakout test, and that we're probably going at least a little higher. We went a lot higher. Whenever the market has a credible top, but it fails and the market starts to go up, the swing stop for the bulls is below the bottom of the bull swing or below the bottom of the breakout. So if you're buying here or here, your stop theoretically is here or here. However, since this is a breakout test and a micro double bottom, and the bulls have a gap that's staying open, it's also reasonable to use a very tight stop right below the low of this breakout test bar. This is an attempt by the bears to make this be an exhaustion gap and the end of a bull trend, and they could not close the gap. They could not get below the breakout point. And that's important for the bulls. And now the market's resuming up. The bulls expect that it'll be able to hold above this low. If it falls below this low, they'll change their mind. They'll stop thinking about this as a possible measuring gap, and they'll think that maybe we're in a trading range, maybe we'll test down to the buy climax low, and maybe all the way down to the low of the day. And therefore, some bulls will use the tighter stop. Reasonable, below the buy climax, below the low of the day. Because once it starts to reverse up here, the probability is high that traders will make at least a measured move up. It's reasonable to take profits at 1 times actual risk. The actual risk is small. For example, if you bought above the high of this bar, by the close of this bar, you know that your actual risk is small, maybe a point or so. It's from just above the high of this bar where you entered to just below the low of that bar. That's how much you actually had to risk to make all this money. And when the actual risk is small, going for a reward equal to 1 times the actual risk, usually not good. You should go for a bigger reward based upon some other measured move target or some other resistance. However, when you have a high probability buy, and at this point the probability is high that you're going to make money at least as much as you're risking, you have a positive trader's equation, and it's okay to take profit at 1 times your actual risk. But just because it's okay does not mean it's sensible. Here, we're probably going up higher, much more than just 1 times actual risk, and it's better to hold on and see what happens. And you can see what happened is the market started to enter a bull microchannel, 5 bars, 10 bars without a pullback, and therefore the first reversal down probably will be minor, and we're probably going higher still. So a bull buying here would continue to hold even here, betting that we're going up at least a little bit higher. For example, measured move. This was an attempt at a top. We broke above it, we pulled back, and we resumed up. Reasonable to expect a measured move up. This is a logical area to take profits, and you can see that's what happened. The bulls stopped buying, bears started selling, expecting to make at least a scalp. Also, a lot of times you get a measured move up based upon the height of the breakout, which is right there. You can see some profit taking there. Two reasonable measured move targets. Therefore, you'd expect some profit taking from the bulls, especially after all of this climactic buying. The stop is now far away, and the bulls don't want to risk that much. One way to reduce risk is to reduce their position size. Whenever the market's in a trading range, it often accelerates strongly after a first leg up, and then that second leg up has no follow through and in fact leads to a reversal. That's a second leg trap. Trading ranges often have two-legged patterns. We have a weak rally, and now it broke into a very strong rally. So you can call this a wedge rally, you can call it a weak rally, and now the market's trying to transition into a strong bull trend. However, because we're still below the prior highs, 50, 60, 100 bars to the left, it might be a bull leg in a trading range. And whenever you get exceptional strength on a possible second leg up in a trading range, it could be an exhaustive move, a second leg trap. You want to see what the follow through is, and a lot of the bears will sell below the bear bar, and a lot of the bulls will get out. Other traders will wait to see if we get 2, 3, or 4 bear bars, and then they'll start to sell closes or above the high of the prior bar. Higher probability to sell after you've seen 3 or 4 decent bear bars closing on their lows. But taking the later sell, you get higher probability. You pay for it with a stop that's further away. It's reasonable to take the early sell. Here we have an II and a bear bar. Or it's also reasonable to take the later sell. This sell has smaller risk, lower probability. This sell has greater risk and higher probability. Both are reasonable. Big down, big up, big confusion, probable trading range. And when you have a probable trading range, 80% of breakout attempts fail. Therefore, you should not be looking to buy at the low of this bar, betting that we're going to get a second leg up. This little bull bar was probably the second leg up. You had buy the close bulls who bought this close. They bought this close. And then they saw this bear bar and they said, uh-oh, that's bad. That's bad. That's disappointing. Maybe I should just get out and look to see what happens over the next several bars. The bulls who bought this close, disappointed by this bar, a lot of them placed limit orders to get out break even. And look at this bar. It got up to that close and not above it. And the bulls who tried to sell out of their longs at their original entry price are now trapped. And they'll start to sell on a reversal down. And this is a pair of give-up bars, the bulls giving up. The bears understand that as well, and they're going to sell. Once they see that the bulls are trapped, they could not get out at the high of this bar, they know the bulls will get out lower, and therefore the bears sell as well. If you're a bull and you're seeing this exceptionally strong breakout and you did not buy lower and you're hoping to buy, I would not be buying with a limit order with that bad follow through and then seeing that the high of this bar could not get above the close of that bar and that this high is below the top of all the bars to the left. Too much risk that it's a second leg trap in what will become a big trading range. Strong enough breakout, probably buyers below, and the best the bears get will be a trading range instead of a bear trend, but I would wait to buy with a stop after I see the market stabilize, and here it never stabilized until all the way down just below the bottom of the buy climax. The bears understand what's going on as well, and a lot of them will take a swing short. Here it would be a swing short. It's 15 points down to this low, so a lot of them will sell, taking a chance that we'll get 2 legs down after the buy climax. Also, because it's a trading range, you'd expect a lot of 2-legged moves. Bear breakout, pull back 2, so 1, pull back 2, 1, it tried to be 1, tried to be 1, tried to be 1, tried to be 1, and now we're accelerating, changing the character of the market. So 1 here is a wedge, it was a wedge here, now it's a bigger wedge, and then 2 is this breakout. And then on the way down, 1, pull back 2. If you take this short, you stop with either above the top of the II, especially since there's a good bear bar closing below its midpoint, or above the top of the buy climax. And if it gets stopped out and it reverses again, you'd sell the second entry as well. Reasonable to take partial profits at the bottom of the buy climax, and you can see that's what happened. A lot of the bears who shorted are betting that it's big up, big down, big confusion, and probably going to be a trading range, and therefore they want to buy back their shorts low. They want to buy low, And the bulls know that as well, and the bulls are looking to buy in the area of the bottom of the buy climax if you get some kind of a reversal. We have a micro double bottom, a bull bar closing on its high, reasonable for the bulls to buy for at least a scalp. Look at this. We have a bull trend, and we entered a trading range for about 15 bars. Now the bull trend is trying to resume. It's a bull microchannel, good for the bulls, but where are the consecutive big bull trend bars? Not present. And therefore, this is a fairly weak rally. Small bars, a lot of overlap, coming out of a tight trading range, failing to break strongly above a significant prior high. Whenever you get a weak rally, you have to assume it's probably going to be a bull leg in what will become a trading range instead of the start of a strong bull trend. And if it's a bull leg in a trading range, a lot of traders will sell a failed breakout and a reversal down. This was a test of yesterday's close and yesterday's high. And we have a little bigger bar here, so it's a buy climax trying to break above the top of the channel. And now we're getting a reversal down, 2-bar reversal up and then reversing down, closing on its low. Might test the bottom of the range. Okay to sell for a scalp down to the bottom of the range. This is also a trading range late in a bull trend and therefore potentially a final bull flag. And sometimes a final bull flag has a breakout that fails to get above the prior high. Here it looks like we got right around to the prior high, right around to yesterday's close. And sometimes that's all that the bulls get in terms of trend resumption before the breakout fails. Bull flag, late in a bull trend, tight trading range, possible magnet, and possible final flag. So if we get a breakout, especially one that's not very strong, even though it's climactic, it's probably not going to go very far. Reversal down, it's after maybe an 8 or 10 bar bull microchannel. Probably the reversal down is not going to be all that dramatic either. Not much energy going up, probably not much energy here. Also not much energy for the first couple of hours today. So just as this was a bull leg in a trading range, probably the reversal down will be a bear leg in a trading range. It's a double top major trend reversal, bull trend, bear breakout, double top, maybe a slightly higher high major trend reversal. But with a 8 or 10 bar bull microchannel, a bull body for the sell signal bar, probably will have to go sideways before the bears can get it to go down. And even though it went down for a second leg, it never went down very strongly. Had you sold here, traders will look for a scalp. Even though it's a possible higher high or a double top major trend reversal, with a decent sell signal bar and a decent entry bar, look at the follow through, doji, big tail, and small body, not a strong breakout below the range. A lot of the bears will decide that this is probably a bear leg in a trading range. Rather than swing trading, hoping for a trend reversal, it's more likely the market's going to go sideways, and therefore they're scalping. They're looking to take profits around the bottom of the range, and certainly on the reversal up, either above this bar, high 2, high 1, right here, and then high 2, double bottom here, or above this bar. This is a double top, I can't tell, might be a slightly higher high major trend reversal, usually followed by a lower high major trend reversal. And this is a lower high major trend reversal. However, there's very little energy. The market's 30 bars into the day, 40 bars into the day. All the bars are small, the follow through is bad. More likely, any reversal attempt will lead to a brief move down, and then the trading range will resume. The bears who sold this, they have to buy back here. They have a bear breakout, bad follow through, a bull bar. They have a bear breakout, even better bull bar. So a failed breakout below the low of the past 4 hours and a decent buy signal bar. The bears will give up. They'll take profits and the bulls will buy for a scalp up. 2 legs down, 1, and then pull back, and then 2. We have a series of sell climaxes. Remember, every bear trend bar is a breakout and a climax. We have a sell climax here, again here, here, and here. And what do you notice? A bear bar, but where's the follow through? It's a doji bar. A bear bar here, and then we get a bull bar. A pair of bear bars, not all that big, and then a bull doji. Another pair of bear bars, and now we're getting a big bull bar. And we're reversing up near yesterday's high, yesterday's close, and the 60-minute moving average. This might be a parabolic sell climax, vacuum test of support. Is it likely to reverse up and become a bull trend? No, but it's likely not to go much further down and probably will attract some profit taking. After a series of sell climaxes, especially after you've had 3, 4, or 5 of them, the odds are it's not going to fall much further and it'll start to evolve into a trading range. The best pair of bear bars, about 15 or 20 bars into the bear trend, and it's at support, 60-minute moving average, yesterday's close, yesterday's high. Probably soon we'll get 10 bars and 2 legs sideways to up. Reasonable to buy above the high of this bull bar. You can either put your stop below or a measured move down and buy more at that low if you'd like. What are the chances that this strong sell-off is going to become a V-bottom and lead to a big reversal up? Small. A very tight bear channel. Probably the best the bulls can get is a bull leg in what will become a trading range. Sometimes you get a surprise and you get a big reversal. Usually you only get it after at least a micro double bottom. We have a bottom here. The bears tried to resume down here, and therefore we have a micro double bottom with these lows, and we have a decent reversal up. A much bigger rally than I think what was likely, but sometimes you still get it. Once you get a big bull bar and then a follow-through bull bar, the market's probably going to rally for some kind of a measured move up, which would take the market up to the top of the sell climax. If a trader bought this and scalped out and he saw this pair of bull bars, he should try to buy again. A second buy signal bar, either above that bear bar or above the bull bar. Micro double bottom. The bears tried to reverse down, low 1, low 2. They could not even trigger the low 2, probably going at least up to the top of the most recent sell climax. We might get all the way to the top of the entire sell climax. By the close of this bar, it looks like the market's going to go higher. It's always in long at this point. Consecutive strong bull bars, consecutive strong bull bars. Even with the bad follow through, we're probably going to get some kind of a measured move up, maybe testing the high of the day. The rally has the same problem that the sell-off had. A series of trend bars with bad follow through, and for the bulls, a bull bar, bear bar, bull bar, bear bar, 2 bull bars, bear bar, 2 bull bars, doji. And this is pretty much the exact opposite of what the bears had. A series of sell climaxes with bad follow through after each climax, a series of buy climaxes with bad follow through after each buy climax, probably limited upside. Here we're at the end of the day. So whatever follow through we're going to get or whatever reversal we're going to get will come tomorrow. I talked about minor reversals today, minor climactic reversals. They're more likely to result in a pause in the trend, and then after the pause, after 10 bars or so, the market decides whether to resume or reverse. They usually do not lead to major reversals, although sometimes they can. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 3 videos on trading climactic reversals.